You know how it is. The price of gas, groceries, pretty much everything is soaring. And common sense tells you to tighten your belt, right? Cut back. But in the world of high finance and the ultra-wealthy, something really strange happens. The most expensive stuff on the planet, it doesn't just survive, it actually thrives. So today, we're going to dive into this really fascinating economic puzzle. Are luxury goods the ultimate inflation hedge? To really get this, we're going to peel back the layers of this economic onion. First up, we're going to tackle the central paradox itself. Then we'll get into the incredible pricing power these brands have. After that, we'll look at how they build these economic fortresses to protect that power. Then we'll hit the core of it, Warren Buffett's idea of the one asset that's truly inflation-proof. And finally, we'll explore how luxury is basically turning into a new kind of currency, and then, of course, wrap it all up. So let's jump right in. The inflation paradox. I mean, it's this central conflict that seems to fly in the face of all economic logic. It's this crazy situation where, on one hand, your money is basically worth less every single day. But on the other hand, the companies making the world's most expensive handbags and watches, they're posting record profits. How does that work? And that really is the question at the heart of all this, right? It feels completely backwards. When every dollar you have is being stretched thin, why on earth would your first move be to buy something that costs thousands or even tens of thousands of those dollars that are losing value? Well, the answer really comes down to one simple truth. Not all goods are created equal, especially when inflation comes knocking. Okay, so this slide just lays it out perfectly. On the left, you've got your everyday commodity goods. Think oil, gas, wheat. It's a simple relationship we all get. Price goes up, demand goes down. You feel it every time you fill up your car. But then you look over at the right, in the world of ultra-luxury, and the rules just get thrown out the window. For brands like Louis Vuitton and Hermes, when the price goes up, demand doesn't drop. In fact, sometimes it actually makes people want it more. And that crazy relationship, it leads us right to our first big piece of the puzzle, the incredible power of price. For these companies, price isn't something they react to, it's a tool they use to control the market. It is their single, most important defense against rising costs.
So, there's a name for this superpower, right? It's called pricing power, and it's exactly what it sounds like. The ability to raise your prices without your customers leaving. In a world where the cost of everything, leather, labor, shipping, is going up, this isn't just a nice little perk. It's the ultimate shield. It's the difference between a company that has to eat those rising costs and one that can just pass them right along to you.
You know, there's this great quote from Warren Buffett that just nails it. Price is what you pay. Value is what you get. And this is so key because it forces us to stop staring at the price tag and start asking, what value does the customer think they're getting? Because let's be honest, these brands aren't just selling you a product. They're selling you something you can't touch. They're selling status. They're selling a story. And this right here is the perfect example. A big pen works. It costs a few cents, it's a commodity, and yeah, sometimes it leaks in your pocket. A Mont Blanc pen, it also writes, but that's not really the point, is it? It's a signal. When you pull out that pen, you're telling everyone in the room something about yourself. See, you're not paying for a thing that writes. You're paying for what that pen says about you. It's a totally different game. So, you gotta ask, right? How do these companies get this power? And more importantly, how do they keep it? Not just for a year or two, but for centuries. Well, they do it by building an economic fortress, or as the legendary investor Warren Buffett calls it, an economic moat. Well, Buffett breaks it down into four main types of these moats. You can have a cost advantage, like Walmart. They're just so cheap no one can compete. Or you can have network effects, like Facebook, where it gets more valuable the more people use it. Some create high switching costs. Think about how annoying it is to change banks. But for luxury brands, the deepest, widest, most powerful moat of all is that fourth one, intangible assets. We're talking brand, reputation, history, the whole shebang. And Buffett himself really hits the nail on the head here. The strongest fortress isn't built with bricks and mortar. It's built inside our heads. The value of a Hermes bag isn't just in the leather and the stitching. It's in the century of desire, of history, of exclusivity that the name Hermes brings to mind. That right there, that's a fortress you just can't break into.
Okay, so how do we prove this whole fortress idea? There's this really cool concept called the Lindy effect. And the idea is pretty simple. For stuff that doesn't have a natural expiration date, like a brand, the longer it's been around, the longer it's likely to be around. Time is the ultimate test. It kills off the weak and the trendy. A brand that survived for 150 years isn't old, it's a battle-hardened survivor.
And just look at this timeline. I mean, it really puts it all into perspective. We're not talking about some hot new startup. Hermes was founded in 1837. Louis Vuitton, 1854. These brands have lived through world wars, the Great Depression, pandemics, you name it. This isn't just luck, folks. This is proof of a seriously powerful and long-lasting economic moat. All right, now we're getting to the absolute core of the onion. If the moat is the fortress that protects the brand, what is the brand itself actually worth? And this brings us to another huge Buffett concept, maybe the most important one for this whole topic, the idea of economic goodwill as the only truly inflation-proof asset.
So think about it. When inflation is raging, all that physical stuff a company owns, factories, machines, equipment, it actually becomes a giant anchor. To maintain it, you have to keep pouring in more and more expensive dollars just to stay in the same place. But that economic goodwill, that reputation, the space the brand owns in your mind, it's a whole different story. It allows a company to make more money without having to build more stuff. It's an asset that just keeps on giving.
And this, right here, is the core idea. The physical things get eaten alive by inflation, but the idea, the reputation, the goodwill, that's protected. And the base example Buffett uses to prove this point has nothing to do with fancy handbags. It's about a simple candy company. Okay, get this. Let's look at the numbers for See's Candy, a company Buffett has owned for a long, long time, over 40 years. With a lot of inflation in there, the company's revenue exploded from $25 million to $300 million. That's a huge jump of $275 million. But here's the absolute magic. Look at the other column. To get all that growth, how much more did they have to invest in stuff, factories and stores? Only $31 million. So where did that other $250 million in growth come from? It wasn't from building more stuff. It was pure profit, powered by one thing, the beloved brand, and its power to charge a little more for a box of chocolates, year after year after year.
Okay, so let's put all the pieces together now. You take that immense pricing power, you wrap it in an economic moat that's been around for centuries, and you power it all with this inflation-proof economic goodwill. When you do that, these companies start to change. They're not just selling you a handbag anymore. They're selling you something else entirely.
And the source material calls it out directly. These things are basically alternative assets now. In a world where people are nervous about stocks and bonds, they're looking for new, safe places to put their wealth. And they're finding it in the last place you might expect, a high-end watch or a classic handbag. Let me break it down like this. A traditional, safe investment, like a government bond, it pays you a fixed amount of cash. But if the government is printing tons of new money, the value of that cash is going down. But now think about something like a classic rare Ferrari. It's a real thing. There's only so many of them, and its value isn't tied to what a government decides to do. In fact, as money becomes worth less, a scarce, desirable thing like that often becomes worth more. It becomes a real store of value. And that is the final incredible transformation here. When there's just too much money chasing too few goods, the power actually shifts away from the money and to the things money can buy. These ultra-desirable, rare products become a shield, not just against rising prices at the store, but against the value of our actual currency going down. All right, let's wrap this all up. We've gone all the way to the center of this economic onion. And what started out as a simple question about why people buy expensive handbags in a recession has uncovered some really deep truths about value, about human psychology, and really about the changing nature of money itself. So when you put it all together, why is luxury such a great inflation hedge? Well, it boils down to these key ideas. First, they have the pricing power to call the shots. Second, their economic moat is a fortress built in our minds. Third, the Lindy effect proves they are tough as nails. Fourth, their real value comes from their economic goodwill, which inflation can't touch. And finally, all of this has turned them into a new kind of alternative asset, a modern way to store your wealth.
So I want to leave you with this one last thought. For hundreds of years, the safest places to put your money were things like government-backed currencies or gold. But if the new safe haven is a Birkin bag or a Patek Philippe watch, what does that tell you about our collective faith in money itself? It's a huge question, and it suggests the whole game of money is changing right in front of our eyes.